There is one commodity on Earth that has no substitute. Oil has solar, coal has gas, food has alternatives, gold has other metals. Every scarce resource has something that can partially replace it if the price gets high enough. Water has nothing. You cannot synthesize it at scale. You cannot import it from another planet. You cannot convince 7 billion people to need less of it. And, unlike oil, which took millions of years to form but can at least theoretically be replaced by something else in your engine, water is irreplaceable in the most fundamental biological sense. Every system that keeps a human being alive runs on it. This is why, quietly and without much press coverage, some of the most sophisticated capital in the world has been moving into water for the last 2 decades. And the vehicle is not water itself. It is something more specific, more legally complex, and more powerful. It is water rights. A water right is not water. It is a legal entitlement to use a specific quantity of water from a specific source under specific conditions. In the American West, those rights are governed by a doctrine called prior appropriation, one of the most important legal frameworks most people have never heard of. Prior appropriation works like this. Whoever claimed the water first gets it first. When there is not enough water to go around, which is increasingly the case, the oldest rights are satisfied completely before newer rights receive anything.
The junior rights holders get nothing. In a drought, that means the person with a right from 1910 drinks. The person with a right from 1990 watches their fields dry up. The older the right, the more reliable it is. The more reliable it is, the more it is worth. This is not a minor technicality. It is the entire investment thesis. Now, the asset that sits underneath this, under the plains of Texas, Kansas, Nebraska, Oklahoma, Colorado, New Mexico, Wyoming, and South Dakota, lies the Ogallala Aquifer, one of the largest freshwater deposits on Earth. It took approximately 6,000 years to accumulate from ancient glacial meltwater. The Ogallala supplies 30% of all groundwater used for irrigation in the United States. It supports more than $20 billion of agricultural production every year. 8 states depend on it. The Ogallala Aquifer is currently being drawn down at a rate equivalent to 18 Colorado rivers per year. In parts of western Kansas and the Texas Panhandle, it is dropping 1 to 3 feet every year. The rate of natural recharge is a fraction of an inch. Within 50 years, the entire aquifer is projected to be 70% depleted. Some counties have less than 25 years of irrigable groundwater remaining. Once it is gone, it takes 6,000 years to refill. This is not a future prediction. It is present tense depletion happening in real time. Some farms above the southern Ogallala have already hit dry bottom.
They just don't talk about it. The people who understood this earliest started buying. T. Boone Pickens built his fortune in oil. He understood scarce resources. Near the end of his career, he made what many considered his strangest bet. He began accumulating water rights above the Ogallala. He eventually owned the rights to drain approximately 200,000 acre-feet per year from the aquifer, 65 billion gallons annually, more water rights than any individual in America. His plan was to pipe it to Dallas, 250 miles, and sell it to a city that would eventually be desperate for it. He understood that the value of a water right is not what the water costs today. It is what the water will cost when the alternative is nothing. He died before the full play matured, but the thesis has only gotten more correct since. Now, the story that tells you exactly what is happening globally: Saudi Arabia grew alfalfa in its own desert for decades to feed its dairy cows. Alfalfa is one of the most water-intensive crops on Earth. Saudi Arabia eventually depleted its own aquifer growing it. The country banned domestic alfalfa production to preserve what water it had left. Then a Saudi dairy company called Almarai quietly purchased nearly 10,000 acres of farmland in Arizona. and began growing alfalfa in the American desert, drawing from Arizona's groundwater, under rules that required no disclosure of usage volume,
shipping the alfalfa back to Saudi Arabia to feed the same cows. Saudi Arabia had run out of water growing a crop at home, so it moved the crop to a country that still had water, and used that country's water for free. When Arizona officials investigated, the groundwater table in the affected county had fallen more than 50 feet in less than a decade. The state eventually terminated the company's leases, but not before an enormous volume of irreplaceable American groundwater had been embedded in bales of hay and shipped 8,000 miles to the Arabian Peninsula. This is called virtual water, the water embedded in exported food products, and it is one of the primary mechanisms through which water-scarce countries are effectively importing the water of water-rich countries, without anyone calling it that. Saudi Arabia was not alone. The United Arab Emirates operates similar alfalfa farms in Arizona and California. Foreign entities control roughly 3% of United States farmland. In dry states with weak groundwater regulation, that ownership comes with nearly unlimited access to what sits underneath. In 2022, two buyers competed in a bidding war for 22,500 acres of ranch land in Washington state. Each was willing to spend over $200 million. One was a company connected to Bill Gates. The other was the Church of Jesus Christ of Latter-day Saints. What they were fighting over was not wheat or cattle. It was the water rights attached to the land. Now, the moment that changed everything, the moment water became a financial instrument. In December 2020, the CME Group, the largest derivatives exchange in the world, launched the first water futures contract in history. The NASDAQ Velis California Water Index, trading under the ticker symbol H2O. For the first time ever, water could be bought and sold as a futures contract, hedged, speculated on, treated like oil, wheat, or natural gas. The contract is priced in dollars per acre foot. 1 acre foot is roughly 325,000 gallons, enough to supply 4 people for a year. In December 2020, the index opened at around $490 per acre foot. By May 2021, it had climbed to $877 per acre foot, an 80% increase in 5 months for water. The introduction of water futures was not primarily about speculation. It was about price discovery and risk management. California farmers facing volatile water prices could now hedge against future scarcity the same way airlines hedge against jet fuel prices. But the fact that it is now possible to trade water as a financial instrument signals something much larger. Water has been formally accepted as a commodity, with a price, with a market, with participants who profit from its scarcity.
The global water and wastewater market is projected to reach $369 billion in 2025 and expand to $650 billion by 2034. 30% of institutional investors surveyed in 2024 had committed over $500 million each to water investments. Goldman Sachs, BlackRock, JP Morgan, Barclays, the Blackstone Group, all building positions, not in water utilities as a defensive play, in water rights, water infrastructure, and water technology as a growth thesis. Now the mechanics of how a water rights portfolio actually works. In the American West, water rights are separated from land ownership. You can own land and not own the water rights beneath it. You can own water rights and not own the land above them. The value of a water right depends on 4 things. First, seniority. How old is the right?
Senior rights from the 1800s are functionally guaranteed even in severe drought. Junior rights from the 1990s may be curtailed entirely in a bad year. Second, location. Rights attached to the Colorado River, which serves 40 million people across 7 states, command premiums because the demand is structural and growing. Rights above the Ogallala, in areas with decades of supply remaining, are different from rights in areas already running dry. Third, use classification. Agricultural rights are typically the least expensive but cover the largest volumes. Municipal rights command premiums because cities are willing to pay more per unit than farmers. Industrial rights, for data centers, semiconductor fabs, and cooling systems, are a newer and rapidly growing category. Fourth, transferability. Some water rights can be leased or sold to third parties. Others are tied to specific land and cannot move. Rights that can be repositioned to where the scarcity is highest are worth significantly more. The most sophisticated plays in this space do not involve directly owning water rights at the individual well level. They involve acquiring large portfolios of senior agricultural rights in drought-stressed regions and leasing them to municipalities, utilities, or industrial users whose own supplies are being cut. You buy the right from a farmer who no longer needs all of it. You lease it to a city that does. The farmer gets liquidity, the city gets security. You hold the asset that appreciates every year the aquifer drops. Now the dimension that makes this genuinely important beyond pure investment. The Colorado River was divided among 7 western states in 1922. The year it was divided was an unusually wet year. The entire allocation was based on an overestimate of the river's average flow. 40 million people now depend on a river whose legal allocation exceeds its actual supply. Lake Mead, the largest reservoir in the United States, has spent recent years at historically low levels. The states are fighting over who cuts more. The math does not balance. Water insecurity could reduce GDP in some regions by up to 6% by 2050, according to World Bank projections. That is not a peripheral risk. That is a macroeconomic event. The people accumulating water rights now are not just making a financial bet. They are positioning for a world where the most fundamental constraint on economic activity is not capital or technology or labor. It is water. T. Boone Pickens saw it through the lens of oil. When you spend 40 years watching a finite underground resource get depleted faster than it recharges, and watching the people who owned the resource get rich while the people who needed it paid whatever price was named, you recognize the pattern when you see it again. Saudi Arabia saw it from the other side. When your own aquifer is gone and you need to grow food, you do not desalinate more water. You buy the land where someone else's aquifer still has decades left. And the financial institutions now building 9-figure water positions are making the same calculation that every investor makes when a price is systematically below its true long-term value. Eventually, the price corrects. The question is not whether water becomes more expensive. The question is, who owns the right to it when it does?